Welcome to this explainer. Today, we're diving straight into what really feels like the ultimate crossroads for the S&P 500. We're going to be analyzing two drastically different expert viewpoints based directly on our source material and breaking down exactly what might happen next in the markets. Because right now, we are looking at a really fundamental divide in market analysis. On one hand, you've got a technical setup flashing warning signs that the S&P 500 is gearing up for a 7% structural crash. But then, on the other hand, you look at the macroeconomic flows, and those are suggesting the market might just get juiced all the way up to the 8,300 level. So how on earth can both be a possibility? Well, let's find out. Okay, here's our quick roadmap for today's explainer. We're hitting the S&P 500 crossroads, the technical bear case, the power of market flows, the path to 8,300, what triggers a crash, and finally, navigating the noise. Starting with Section 1, the S&P 500 crossroads. We're getting some incredibly mixed signals as the market hovers right near all-time highs, which really forces us to look under the hood at the mechanics driving the price action. You know, to really grasp where our first source, full-time trader Justin Bennett, is coming from, we've got to define his methodology. It's called Smart Money Concepts, or SMC. Basically, this approach tracks institutional market structure. A really critical piece of this whole puzzle is what's called a break of structure, or BOS. Bennett uses this to figure out if institutional buyers or sellers are the ones actually controlling the trend, completely bypassing the day-to-day noise of retail trading. Moving right along to Section 2, the technical bear case, looking specifically at Justin Bennett's view. With that SMC framework in mind, let's explore his purely technical bearish setup for the coming weeks. So Bennett is mapping out a super specific sequence of events on the charts here. He isn't just throwing darts and predicting a random drop. He's watching for a very calculated technical breakdown. First up, he's eyeing a pullback into what's known as a daily fair value gap, which is basically a zone where the price hasn't fully tested past levels. Step 2, once it hits that zone, he's looking for a lower time frame change of character. That would basically confirm the top is in and the sellers are officially taking over. And finally, that move would lead to a break of the weekly external structure, signaling a much, much larger breakdown. And where does that breakdown actually lead us? Well, Bennett points out that if we get a weekly close below key support, it triggers a massive drop. If you zoom out and look left on the weekly chart, he highlights this massive, unmitigated weekly displacement candle from the past. It's essentially this huge, sudden drop in price that the market never actually went back up to test. If the structure breaks today, he's projecting a 7% drop straight down to the 6,000 level to test that exact imbalance. It's a very precise, technically driven argument for a pretty severe pullback. But wait, what if the charts are just completely ignoring the underlying mechanics of global money? That brings us to Section 3, the power of market flows, and Dr. Sven Carlin's view. Now, a core concept Carlin leans heavily on here is the inelastic market hypothesis. Based on research from places like Harvard and Chicago, this economic theory suggests that the stock market does not grow dollar for dollar. Instead, every single dollar invested acts like a multiplier. It doesn't just add a dollar of value, it actually boosts the overall market capitalization by roughly $5. Let's actually put some numbers to this, because it brilliantly illustrates the math in our current market. Just look at these flows. We've got an estimated $1 trillion coming in from corporate buybacks over the last 12 months. Apply that 5x multiplier, boom, that is a $5 trillion increase in market cap. Add to that a record-breaking $1 trillion in U.S. ETF inflows, that's another $5 trillion increase. Combined, a $2 trillion capital injection creates a totally staggering $10 trillion surge in overall market capitalization. Which leads us right into Section 4, the path to 8,300, driven by these uninterrupted flows. The crucial point we have to understand is where these relentless flows could push the index if they just keep going. Carlin notes that if no economic crash happens and things like AI spending, stimulus, and potential Fed rate cuts just continue to juice the market, the overall market cap could swell to roughly $70 trillion. In terms of the S&P 500 index, that mathematically projects the market going straight to 8,300, just straight up to the moon, purely based on uninterrupted financial flows. But of course, there's a catch. Carlin warns this creates a very dangerous tale of two markets. On one side of the tug of war, we've got speculative momentum and passive ETF inflows pushing prices higher and higher. But on the other side, the actual fundamental shareholder yield is sitting at a historically low 1.9%. As Carlin puts it, a 1.9% yield is absolutely not going to let you retire. It basically proves we are in a speculative gambling market that is completely reliant on those capital flows continuing. All right, Section 5. What triggers a crash? Let's talk about the systemic risks that could actually reverse this. Because we're in a flow-driven market, a real crash would require a systemic shift that essentially shuts off the money hose. Carlin outlines a few major risks from our sources. First, a recession. A recession instantly halts corporate buybacks, pulling that massive flow of capital right out of the market. Then, demographics. 18% of the population is now over 65, right? Eventually, they have to stop buying and start selling their assets to fund their retirement. Then you've got the risk of modern monetary policy failing. Like, what if the Fed cuts rates and it literally just doesn't work? Add in the risk of the AI bubble bursting, which investor Michael Burry predicts could happen within the next 24 months. And finally, there's the very real threat of higher taxes. Carlin even notes that Warren Buffett already sold his Apple stock in anticipation of higher future taxes driven by massive wealth inequality. And look, we absolutely cannot ignore the raw macroeconomic pressure of inflation. Over the last 5 years in the US, inflation has surged a massive 25%. That kind of compounding price pressure makes the fundamental landscape incredibly fragile. It could easily lead to a panicked capital flight if investors suddenly wake up and decide that holding highly overvalued stocks is just no longer worth the risk. So, how do we handle all of this? Section 6, Navigating the Noise by focusing on the fundamentals. With both a looming technical drop from the charts and speculative flow-driven highs on the table, how should we actually process this? Dr. Carlin really hits the nail on the head with this grounding perspective. He says, rather than trying to perfectly time the noise, or guess the exact day the market drops 7%, or try to ride the flow perfectly to 8,300, you've got to focus on the fundamentals. Make sure you are positioned so that on one side, you're betting on the long-term compounding of your wealth, but on the other side, you are protected. Find a way so that whatever happens, whether the market crashes next week or in 2026, you do well. So as the S&P 500 stands at this massive critical crossroads, I'll leave you with this final thought. Are you going to try and outsmart the technical chart patterns week by week, or will you build a fundamental, long-term strategy that's actually capable of surviving any macroeconomic crash? Thank you for joining me on this explainer. Keep learning, stay focused, and we'll see you next time.